When most people look at a stock chart, they just see this chaotic, jagged zigzag of lines.
Yeah, this looks like noise.
Right, exactly. It looks like cold, unforgiving math, like a random number generator plotted on an axis. But what if you weren't looking at math at all? What if you are actually looking at, like, a heart monitor?
Oh, I like that analogy.
Yeah, a literal EKG tracking the pulse of millions of humans all experiencing greed, fear, regret, and panic, in real time.
It completely shifts your perspective on the market. I mean, the moment you stop seeing it as a wall of random numbers and start seeing it as this highly detailed map of human emotion and strategic behavior, the chaos actually starts to make a terrifying amount of sense.
It really does. And I was digging into our source materials for today's deep dive. We're looking at a stack of trading platform guides from TradeVision and CapMint, plus a really comprehensive technical analysis manual, and some fascinating transcripts on something called fractal market flow.
Oh yeah, the fractal stuff is wild.
It's mind-blowing, and that was the biggest realization for me. Our mission today, for you listening, is to decode the hidden language of financial markets. But before we even get to the mechanics of placing a bet on a stock, we have to talk about why anyone thinks staring at historical prices actually works.
Right, because it's a bold claim.
It's a huge claim to say you can predict tomorrow by looking at a squiggly line from yesterday. Okay, let's unpack this. Where do we even start?
Well, that brings us straight to the foundation of all this, which is technical analysis.
Mm.
And the core philosophy of technical analysis is actually pretty radical. It demands that you completely ignore fundamental factors.
Wait, completely. Like you just ignore the company's balance sheet. You don't care if they, I don't know, just fired the CEO or invented a cure for a disease.
Yeah, the pure technical analyst doesn't care if the company makes revolutionary software or, sells cardboard boxes out of a garage.
Wow.
They operate on one core assumption, which is that the market is perfectly efficient. There's this famous mantra in the discipline: the market discounts everything.
Meaning that whatever the CEO just did, or whatever the earnings report says, whatever the fundamental data is, it's already baked into the current price of the stock by the time you or I even hear the rumor.
Precisely that. All possible price-sensitive information is assumed to be instantaneously built into that price graph. So analyzing the news is, well, it's a waste of time to them.
All right, because the chart already knows.
Exactly. The only thing that matters is the price movement itself, and that movement is governed by trends. The oldest method of mapping these trends is Dow theory.
Like Dow Jones?
Yeah, developed by Charles Dow, the co-founder of the Dow Jones, over a century ago.
It's wild that we were still using century-old theories to trade modern tech stocks. I mean, reading through the manuals, the best way I could visualize Dow theory's 3 trends is by thinking about the ocean.
The ocean is the perfect way to look at it.
Right, so you have the primary trend, which is like the ocean tide. It lasts for months or even years, slowly coming in or going out. It's the big macroeconomic bull or bear market. Then you have the secondary trend, which is like the waves crashing against that tide.
Yep, the pullbacks.
And finally, the minor trend, which is just the day-to-day ripples on the water.
The ocean analogy captures the mechanics perfectly. Technical analysts map these tides and waves by looking at what they call swing highs and swing lows.
Okay, what does that look like?
So if you want to spot an uptrend, a rising tide, you aren't looking for a straight vertical line. You are looking for a series of higher highs and higher lows.
It looks like a staircase going up.
Exactly. It physically demonstrates that the buyers are consistently stronger than the sellers. Every time the price dips, buyers step in, and they're willing to pay a higher price than they were during the last dip.
And a downtrend is just the inverse. Lower highs and lower lows, meaning the sellers are in control. They're overwhelming the buyers and accepting lower and lower prices just to get out.
Right, panic selling.
And if it's moving sideways with flat highs and flat lows, supply and demand are basically deadlocked in a tug of war. But hold on, I have to push back here. If history always repeats itself, which is the core assumption here, and these ocean tides are so neatly defined on a chart, why isn't every day trader studying these lines incredibly rich?
That is the million-dollar question. And the answer is because while the rules are simple, the reality is a visual nightmare due to something called fractal market structure.
Fractal, like those trippy geometric shapes that repeat forever no matter how close you zoom in.
That's the exact mathematical concept.
Yeah.
Price action is fractal because those 3 Dow trends, the tide, the waves, the ripples, are happening simultaneously. You can actually have a vicious, terrifying downtrend happening inside a larger uptrend.
Wait, really? Inside it?
Yeah, entirely, depending on your time frame. What's fascinating here is how perspective changes everything.
Okay, walk me through how that actually looks to a trader staring at a screen.
Imagine you pull up a 10-minute chart for a stock. The price is plummeting. It's making lower highs and lower lows all morning. It looks like a crash, so you panic and sell.
Right, because the sky is falling.
But if you zoom out to a monthly chart, that morning crash is literally just a tiny, microscopic pullback in a massive, multi-year bull market. Depending on your perspective, the price is going up and down at the exact same time.
Oh, wow. So it's all relative.
Exactly. This fractal nature creates massive opportunities, but it's also the primary reason inexperienced traders get chewed up.
Okay, so since these trends aren't just smooth, strafe shots to the moon, it explains why they constantly bounce off these invisible ceilings and floors. Like, you look at a chart and the price drops to $50, magically stops, goes up, drops it back to 50, and stops again. It's like it's hitting concrete.
It really does look like magic until you understand the mechanics.
Right, and this takes us right out of abstract math and into the raw human emotion we talked about at the start.
Yeah, we call those invisible barriers. Support and resistance levels. Support is the floor. It's a price level where demand is strong enough to physically stop the price from dropping any further.
Because it's suddenly on sale.
Exactly. As the price gets cheaper, buyers get greedy and step in. Resistance is the ceiling, where supply is so strong it stops the price from rising. Buyers get exhausted and sellers take over.
The psychology behind this is fascinating. The guides break down exactly why a level like $50 becomes a concrete floor, and it's driven almost entirely by the psychology of regret.
Regret is a powerful driver in the market.
So let's put the listener in the shoes of the three different groups that create this floor. Imagine you are in group 1. You bought the stock at 50, you watched it go up to 55. You feel like a genius, but you wish you had bought more.
Naturally.
So you vow, if it ever bids back to 50, I'm doubling down.
And that's your first massive wave of demand waiting at the $50 line. Then you have group 2. Imagine you are the uncommitted trader. You watched the stock sitting at 50. You hovered your mouse over the buy button, but you hesitated.
Oh, I've been there.
We all have. Then you watched it sail away to 55. The fear of missing out, the FOMO, is eating you alive. You tell yourself, if the market gives me a second chance at 50, I am not hesitating.
Right, so that builds your second wave of pent-up demand.
Exactly. And then group 3, which is pure agony. Imagine you sold your stock at 50. You took your profit, patted yourself on the back, and then watched in horror as the stock kept climbing to 55.
That is the worst feeling.
It is. Now you just feel stupid. You regret selling so deeply that you want to right your wrong by buying the stock back at the exact price you let it go for.
So when the price finally drops back to 50, all three of these groups hit the buy button simultaneously.
Yep. The combined psychological weight of their greed and regret creates a literal physical barrier on the chart.
That is so cool.
And taking that a step further, we see a phenomenon called role reversal.
What happens there?
Well, when one of these massive emotional barriers finally shatters, say the macroeconomic news is so bad that the selling pressure overwhelms all three of those buying groups and the $50 floor breaks, the psychology flips.
Oh, because everyone's trapped.
Exactly. Everyone who bought at 50 is now losing money. So if the price ever climbs back up to 50, they will immediately sell just to break even. That broken floor becomes the new ceiling. Broken support becomes resistance.
Wait, if I'm trading, my instinct would be the exact opposite. If a massive $50 ceiling finally breaks, that means the buyers won the war, right? So I should just buy the stock the exact second that line is crossed to ride the momentum upward.
That instinct is exactly what large institutions rely on to take your money.
Wait, really?
Yeah. Buying a breakout the moment a line is crossed is arguably one of the most dangerous moves a retail trader can make. It all comes down to the mechanics of liquidity and stop hunting.
Stop hunting sounds like a predatory sport.
Oh, it absolutely is.
Yeah.
To understand how it works, you have to look at the mechanics of the order book. Think about where the market is deepest with automated orders.
Right.
All the breakout traders, like you just described, are putting their buy orders right above the ceiling.
Right.
And everyone who is currently holding the stock has their stop-loss safety orders sitting right below the floor to protect themselves if it crashes.
So it's just a giant cluster of automated buy and sell orders waiting to be tripped.
Exactly. It creates massive, dense pools of liquidity. And large market players, the smart money, the hedge funds, the banks, they know exactly where these pools are.
They can see the traps.
They build the traps. Here's the mechanical problem a big bank faces. If they want to sell 1 million shares of a stock, they can't just dump them on the open market.
because there aren't enough buyers.
Right. If they dump 1 million shares, the price will instantly collapse from 50 down to 30, and the bank loses millions of dollars. They need a massive influx of buyers to absorb their shares at 50.
Oh, I see where this is going. They need 1 million people to suddenly want to buy the stock.
Exactly. So they purposely push the price just past the resistance line to, say, 51. This triggers the automated buy orders of all the retail breakout traders.
Wow.
The retail traders think the ceiling broke, it's going to the moon, and they rush in to buy. They provide the exact liquidity the big bank needs. Once the retail traders are sucked in, the smart money unloads their massive million-share sell order onto them.
That is incredibly brutal.
The big bank gets out at a great price, the buying pressure evaporates, and the price plummets back down. It's called a false breakout or a bull trap. The retail traders are left holding the bag at the absolute top.
They are literally engineering the breakout just to use retail traders as exit liquidity. That's wow. And because this psychological tug of war and this institutional stop hunting happen constantly, the sources say they leave recognizable footprints on the chart.
Yeah. Specific, identifiable shapes that appear over and over again, like battle scars.
Traders categorize these footprints as patterns, right? And broadly, they fall into two camps. You've got continuation patterns, which signal the trend is just pausing to catch its breath before resuming, and reversal patterns, which signal the trend is exhausted and about to violently change direction.
Exactly.
The reversal patterns are fascinating because they literally look like letters. You have the double top, which looks like an M. The price hits the ceiling, drops, tries one more time, hits the ceiling again, and then gives up.
Yeah, the buyers just run out of steam.
And the double bottom is the inverse, a W shape. And then you have the famous head and shoulders pattern.
The head and shoulders is a textbook indicator of a dying uptrend. You have a peak, the left shoulder, then a higher peak, the head, and then a lower peak, the right shoulder.
So it actually looks like a silhouette.
Yeah, and that lower right peak is the visual confirmation that the buyers are losing their strength. When the price breaks below the neckline, connecting the lows of those peaks, it triggers a massive wave of selling.
But the pattern that really stood out in the Capmint manual, because it perfectly illustrates the institutional trap we just talked about, is the rally-based drop, or RBD.
Oh, the RBD is a classic.
Walk me through the anatomy of this one. It happens in 3 distinct phases, right? Phase 1 is the rally, a rapid, almost panic-inducing upward move. Phase 2 is the base, a pause where the price just moves sideways in a tight little box. And phase 3 is the drop a sudden, violent fall.
You've got it. And the base phase is the crucial mechanism here. To the untrained eye, the base just looks like a boring, random pause in the market. But that base is an order accumulation zone.
So that's where the trap is set.
Exactly. That tight sideways box is where the smart money is quietly setting the trap. They're absorbing all the buying pressure from the retail traders who think the rally is going to continue, and the institutions are using that liquidity to build a massive short position.
Oh, so they're betting against it while everyone else is buying?
Yes, and when they are finally loaded up, they pull their support, and the floor falls out. That's the drop.
But if I'm looking at a chart, how do I know if a sideways base is a real institutional trap being set, or if it's literally just a boring Tuesday where nobody is trading? The manuals talk a lot about using candlesticks and volume to filter out the fakes.
Reading candlesticks is essential for seeing inside the base. Unlike a simple line chart, a candlestick shows you the open, high, low, and close of a specific time frame.
Like those little colored rectangles with the lines sticking out.
Exactly. The thick part, the body, shows the difference between the opening and closing price. If it opens at 10 and closes at 15, you have a large, solid body.
And the little thin lines sticking out the top and bottom, the wicks, show the extreme highs and lows the price hit during that time before settling back down.
Right. So for a base to be considered a valid trap in a rally-based drop, you want to see incredibly small candlestick bodies.
Why small bodies?
The rule of thumb is the body should be less than 25% of the total length of the candlestick from wick to wick. It visually proves that the market is in a chokehold. Neither buyers nor sellers can make any ground.
Okay, that makes sense.
But the ultimate lie detector is volume, the actual number of shares changing hands.
How does volume expose the trap?
During a valid base, the trading volume should drop significantly. It's the calm before the storm as the institutions quietly accumulate. Then, the moment the drop happens, the volume should aggressively spike.
So you need the volume to confirm the move?
Exactly. A huge red candle combined with massive volume proves that the big players have made their move and are dumping the stock. If the price drops but the volume is low, it might just be a fake out.
So volume is the real lie detector. Now, what happens when the market is moving so fast that it skips the candlesticks entirely, like a tug of war where one side just completely drops the rope overnight?
You're talking about gaps.
Right, gaps. The stock closes at 40 on Tuesday, and on Wednesday morning it opens at 45, leaving a literal blank space on the chart. The sources break down breakaway, runaway, and exhaustion gaps.
Breakaway gaps are the easiest to spot. The stock has been stuck in a boring sideways base for weeks, and suddenly it blasts out of that box with intense enthusiasm, leaving a gap behind it. It signals the start of a brand new trend.
Now, I was reading about the runaway gap, and I couldn't help but connect it to the greater fool theory.
Oh, that's an interesting connection.
Yeah, the greater fool theory is the idea that you can buy a stock at an objectively ridiculous, overvalued price, banking entirely on the hope that someone else, a greater fool, will come along tomorrow and buy it from you for even more.
Right.
Is a runaway gap just the visual manifestation of that panic? Like traders who are terrified of missing out, jumping in late, praying a greater fool will save them?
That's actually a perfect application of the theory. A runaway gap happens right in the middle of an already strong trend. The people buying there are the ones who sat on the sidelines during the breakaway gap, watched the stock climb 20%, and finally broke down in an absolute panic.
They just couldn't take it anymore.
Exactly. They buy in all at once. It is pure FOMO, driving the price up so fast it skips levels.
But the manuals issue a massive warning here because an exhaustion gap looks almost identical to a runaway gap on the surface. But it means something entirely different.
It means the exact opposite. An exhaustion gap doesn't happen in the middle of a trend. It marks the dying final breath of a trend. It is the last gasp of the desperate buyers before a massive catastrophic collapse.
So if you mistake an exhaustion gap for a runaway gap, you are literally buying at the absolute peak right before the crash. You become the ultimate greater fool.
Yep, there is no one left to buy it from you.
How do you mechanically tell them apart before it's too late?
It comes right back to the lie detector volume. An exhaustion gap will almost always be accompanied by exceptionally unnaturally high volume.
Because the smart money is dumping.
Exactly. That gap is the exact moment the smart money is transferring all of their shares to the late panicking retail traders. The institutions are sprinting for the exits while retail is breaking down the front door to get in. If you ignore the volume spike, you will walk right into the slaughterhouse.
Okay, so let's put this all together. You've analyzed the chart, you understand the regret psychology at the support line, you've spotted a rally-based drop pattern, you've checked the volume to confirm the institutional trap is set, and you know the drop is coming.
You have your thesis.
Right. What is the actual mechanism for placing the bet? You don't have to just short the raw stock. The manuals pivot heavily here into the tools of the trade, which are options.
Options are essentially financial contracts. They give you the right, but absolutely not the obligation, to buy or sell a stock at a specific price, which is called the strike price, by a specific expiration date.
And they come in two flavors, right?
Yeah. Calls, which are bets the stock will go up, and puts, which are bets the stock will go down.
Let's unpack the mechanics of the 5 beginner strategies they outline, because they sound incredibly complex but actually map to everyday concepts.
Sure.
The long call is the simplest. You pay a small premium to buy a call option because you think the stock is going up. The way I visualize this is buying a TV on layaway.
Layaway, okay.
It's like paying a store $10 today for a coupon. That coupon legally guarantees you can buy a new TV at today's price of $500 next month. Even if the store suddenly raises the price of the TV to $1,000, you still get it for $500 because you hold the contract.
The TV coupon analogy translates perfectly to the market.
Yeah.
The $10 coupon is your option premium. The $500 is your strike price. If the stock rockets to $1,000, your $10 coupon becomes incredibly valuable.
Because you can buy it way below market value.
Exactly. Building on that, the second strategy is the covered call. Imagine you already own the $500 TV. You don't really want to sell it, but you're willing to if the price goes crazy, so you act as the store.
Oh, I sell the coupon.
Right. You sell that $10 coupon to someone else. You collect their $10 premium today as pure income. If the TV stays at $500, the coupon expires worthless, and you keep the TV and the $10. It's a way to generate rent on stocks you already own.
So what about the downside? Say I spot that rally-based drop trap, and I know the floor is about to fall out. How do I profit from the crash?
That's where you use the third strategy, the long put. A put option gives you the right to sell a stock at a specific strike price. If the stock is at 50, you buy a put option with a $50 strike price.
Even if it crashes?
Yep. When the trap springs and the stock plummets to 20, you still have the legal right to sell it at 50. You make a fortune on the difference.
What if I want to play the casino instead of the gambler? Can I be the one selling the put?
You can. That's the fourth strategy, the short put. You sell a put option, collecting a premium up front. You are essentially betting that the stock will stay above a certain level. You are acting exactly like an insurance company writing a policy.
Okay, that makes sense.
And finally, the fifth strategy is the married put. This is when you own a stock you love, but you are terrified of an upcoming earnings report. So you buy a put option to lock in a floor price. If the stock crashes, your put option gains value and offsets your losses. You are literally just buying an insurance policy for your own portfolio.
The insurance analogy makes total sense, but I have to ask, isn't options trading just a cheap, highly leveraged way to gamble? I mean, people blow up their entire accounts doing this. What is the actual risk exposure here?
The risk comes down entirely to whether you are buying the contracts or selling the contracts. And the mathematical asymmetry between the two is huge.
How so?
If you are buying an option, a long call or a long put, your risk is strictly defined and capped. If you pay $100 for that TV coupon, the absolute worst-case scenario is that the stock goes the wrong way, the coupon expires worthless, and you lose your $100.
Okay, so your downside is capped, but your upside is theoretically unlimited if the stock rockets.
Exactly. But if you're the one playing the insurance company,
What I'm selling that short put.
the math violently flips. If you are selling a short put, your maximum profit is strictly capped at the small premium you collected up front. Let's say it's $100. That is all you will ever make.
But what's the risk?
Your risk is massive because you are legally obligated to buy that stock at the strike price. If the company goes bankrupt overnight and the stock plummets from 50 to 0, you are forced to buy thousands of shares of worthless stock at $50 apiece.
Oh my God.
Yeah, you are risking devastating capital losses just to make a guaranteed $100 up front.
Wow. So you're risking a fortune to make $100. That sounds like picking up pennies in front of a steamroller.
That is the exact phrase veteran options traders use to describe selling naked puts. If you trip, you get flattened.
That is terrifying. So to summarize this incredible journey we've been on today, we started with the abstract philosophy of technical analysis. You know, this radical idea that the market discounts everything and only the price matters.
Yeah, ignoring the fundamentals entirely.
Right. And then we moved into the raw, visceral human psychology of regret and FOMO that physically creates support and resistance floors on the chart. We explored how institutional stop hunting leaves mechanical battle scars, like the rally base drop pattern.
The footprints of the smart money.
Exactly. And finally, we unpacked how traders actually monetize those predictions, navigating the asymmetrical risks of buying and selling options. Whether you are actively managing your own portfolio or you just want to finally understand what the talking heads on financial television are screaming about, you now know that a stock chart isn't just math. It is a mirror reflecting human nature back at us.
It really is. And, looking at that mirror leads to a rather profound question about the future.
Oh.
Well, technical analysis is built entirely on the premise that history repeats itself because human psychology, our regret, our fear, our greed, never changes. The patterns work because humans are predictable.
Right, because we all feel FOMO.
But what happens to the market structure when the vast majority of trades are no longer executed by emotional humans sitting at desks, but by AI algorithms that don't feel regret?
Oh, wow. That changes everything.
Will these centuries-old patterns stop working? Or will the machines just learn to hunt each other, leaving entirely new alien patterns in their wake?
That is a fascinating, heavy thought to leave on. Machines, hunting machines, and the liquidity pools. But the next time you see that jagged zigzag of a stock chart scrolling across a screen, just remember, you're not looking at pulled math. You're looking at a heart monitor. And now you know exactly how to take the pulse. Thanks for joining us on this deep dive.